Okay, well, we're going to go ahead and get started. I see we still have a few people joining, but we certainly want to be considerate of those who have joined on time. My name is Rob Cochran, and I want to welcome everybody to the webinar that we're holding today on long-term care planning. So we're going to spend some time going through some very important things that all of us really need to be aware of and prepared for as we plan for this event as we age. I want to just cover a couple things with you first. There's a toolbar on the right-hand side that you can ask questions as we're going through. We obviously may not be able to answer all the questions, but we'll certainly try to answer some of them and get through as many as we can with time permitting. So let's go ahead and jump into our presentation for today because I know everybody's time is very, very valuable. Again, my name is Rob Cochran. I'll tell you a little bit about me. I'm the lead long-term care agent for member benefits and have been for about 20 years. So this is all I do is specialize in long-term care protection. I've written 2 books on the subject. One is called Pills and Bills. The other one is called The Truth About Long-Term Care Insurance. I want to talk to you about the agenda that we're going to cover, what we're going to actually address today. And we're going to start by talking about what is long-term care exactly, because a lot of times people are confused about that term and what exactly it means. We're going to discuss how this coverage helps protect our retirement plans. We're going to spend some time dispelling many of the myths that people believe about this subject, and then we're going to talk about the different types of long-term care plans that are available through the Member Benefits Long-Term Care Program. So what is long-term care? It's the assistance or supervision that somebody needs because they can't do their activities of daily living on their own. And the activities of daily living are listed there in the second bullet point. Bathing, dressing, toileting, transferring, which is moving around, continence, or eating. So if somebody needs assistance of another person to do any 2 of those 6 activities of daily living, and the doctor expects that they're going to need that assistance for at least 90 days, because again, we're talking about long-term care here, then that qualifies as a valid long-term care event under a long-term care policy. That's one way. The second way is if somebody needs supervision due to a cognitive impairment, such as Alzheimer's or dementia. And actually, Alzheimer's is the fastest growing area of claims that long-term care companies pay. This type of care can take place in a variety of different settings. The place that most of us would choose to be cared for is in the comfort of our own home, and we call that aging in place. Another place is an assisted living facility. Some of those can actually be quite nice. And then a nursing home or a skilled nursing facility, they go by both names, is yet another place. And a fourth one that's not listed on the screen would be an adult daycare center, where a loved one is taken during the day to be monitored and supervised, but they don't stay overnight. They're picked up and brought home at the end of the day. And the cost, of course, of the care varies depending on where we're receiving the care. For home care, a home health aide generally costs about $20 an hour. So if somebody needed 5 hours of care a day, they'd be looking at about $100 a day, $3,000 a month, $36,000 a year. If they need 8 hours a day, they're looking at about $160 a day or $4,800 a month. And you can just, figure the math out depending on how many hours of care somebody needs. Assisted living facilities, the median average is about $41,000 per year. Of course, it can vary based on the location where somebody is geographically and the facility, but that gives you a range. And nursing homes, the median average is about $73,000 a year. Again, it's going to be more than that in some places around the country. What we're all trying to do is save money for retirement, and we're doing that through different vehicles, whether it be 401k plans, IRAs, real estate, or different savings vehicles. And the goal is to preserve that wealth that we've been putting aside and taking investment risk on to try to accumulate for our retirement needs. The goal with long-term care protection is to protect that wealth. That's an important thing because another statistic shows, this was a Genworth 2013 study, shows that for a private room in a nursing home, the average cost was almost $84,000 a year. The reality is most people, if they have, the ability, they're going to want a private room versus a semi-private room, which might be a little bit cheaper, but not a lot, but where you have a curtain down the middle and 2 TVs going and, different sets of visitors, and it's just really chaotic. So most of the members would certainly want to be cared for in a private room. What this slide shows is some interesting things. If we look at the different risks that we protect ourselves against and that we're concerned about, we see some interesting things. Number one, we look at the car, the picture of the car at the top. Most all of us, I would say all of us have auto insurance, and that's a wise thing to do. And that's considered a moderate risk on the risk scale. If we look to the left at the picture of the home, we all have our homes insured, and that's actually a very low risk item. Only about 1 in 1,200 homes burn down or get destroyed by fire. So it's not real likely to happen, but of course it's a prudent thing to do to protect our home because it's a very large asset, and we'd be sick if we had to pay for it out of our own money if it did burn down. On the right-hand side, we have health insurance. Obviously, that's a very high-risk item. But look at the bottom of the picture there. Long-term care is also a very high-risk item. The Department of Health and Human Services has projected that 7 out of 10 of us, 70% of us that reach the age of 65, are going to need this kind of care during our lifetime. So it's much higher than a lot of the things on this chart and a lot of the things that we protect ourselves against. But you'll notice there in bold, for many, many people, they are uninsured and not protected for it, which logically doesn't make sense, but it's basically because they're not aware of these odds and they don't understand the information that we're going through today. And some of the reasons why people don't or haven't addressed this issue are some of the myths that we want to spend a little time on. One thing that you'll hear people say is that, I'm too young. I don't need to worry about this because I'm in great health and I'm young. But the person who says that doesn't realize that 40% of the 13 million Americans who currently need help with this kind of care in our country are working age, between 18 and 64. So this doesn't just happen to people in their 60s, 70s, and 80s. Certainly the older we get, the more likely it is to occur, but 40% of the care happens to people that are working age. Another myth is sometimes, believe it or not, I hear people say, well, I don't think it's going to happen to me. I just think I'm going to be lucky. There's good genes in my family and so forth. But again, the person that says that isn't thinking and isn't aware of all the different things, literally hundreds of things that can cause the need for this kind of care. On the left-hand side of this chart, we see injuries. People can need this care because of accidents or injuries from motorcycle or car accidents or avocations like skiing or horseback riding, fractures, falls, things like that. And then on the right-hand side, we have the major health conditions. And again, there's an enormous number of health conditions that can cause the need for care, but these are the major ones that we see. Stroke and heart attack, cancer, diabetes, Alzheimer's is listed there, Parkinson's, MS, and just the normal aging process of just getting older. So it's very, very long, the list of the things that can cause us to need this type of care. Another myth that people think is, well, as prevalent as this is, as likely as it is to happen, certainly my health insurance must cover this, or some governmental program like Medicare must cover it. But the reality is that they don't. And the reason is the issue that we're concerned with when it comes to long-term care is that bottom category there to the left that says custodial care. Custodial care is the care that people need, the help they need with those activities of daily living, eating, bathing, dressing, toileting, transferring from a bed to a chair, things like that. They don't need a skilled person to help them do that. They don't need an RN. They don't need a physical therapist, a speech therapist. That's up there in the category of skilled care, and some of it would fall into intermediate care. But custodial care is where 93 to 94% of all the care that people need for long-term care in our country falls. All they need is someone to help them do those activities of daily living. That's not covered at all under our health insurance. Not covered under Medicare for long-term ongoing custodial care either, because Medicare is basically our health insurance once we turn 65. And Medicare pays for doctor's bills and hospital bills and things like that. Some prescription medications can be covered under it. But Medicare's focus is on curing people, not caring for people. And they also have some requirements listed there that make it very difficult for people to qualify a lot of times for even the short-term benefits that Medicare offers. But basically, in a facility, Medicare in a skilled nursing facility, Medicare pays the first 20 days if certain requirements are met, which very often are not. And then the next 80 days, the person has a large copayment they have to pay out of pocket. And then after 100 days, Medicare's done. The individual has to pay the rest of it themselves. So Medicare was never designed to pay for long-term ongoing care. Medicaid is a program for the poor, the poorest of our society. It is not an entitlement program. It is a means-tested program. People have to spend down their own assets in order to qualify for care. So generally, somebody either is very poor when they begin, if they end up on Medicaid, or they maybe had some assets, but they ended up not planning real well, and they ended up having to spend their money, go through their assets, and then they end up being on Medicaid. But the problem with Medicaid for most people is, number one, you have to be poor, which most people do not want to do. That's not their goal, obviously. And number two, most of the Medicaid care typically takes place in a nursing home, the one place nobody wants to go to. It's very difficult to get care in settings other than a nursing home because of the funding levels that are just not very prevalent. Some people think, well, the federal government, again, must be going to get involved in this, but they've clearly shown their intent through legislation that has been passed over the years. In 1996, they passed the Health and Welfare Reform Act that made premiums in certain scenarios deductible for long-term care insurance and made the benefits tax-free in virtually all situations for long-term care insurance, incentivizing people to address this issue for themselves. The Deficit Reduction Act of 2005 increased the look-back period to qualify for Medicaid, delayed the penalty period, and limited the ability to use annuities to shield assets. Some of the strategies that people would use sometimes to impoverish themselves on paper to try to qualify for Medicaid, a lot of those loopholes have been closed. And then in the Obamacare, there was a provision called the Class Act that initially was in the legislation, but it never made the final cut because once they started analyzing it, they realized it was just not going to be financially sustainable. And it wasn't going to do anything for healthy people anyway. It was for people that were basically disabled and uninsurable. It provided a small level of coverage, but it never ended up making it. Another myth that people have is, well, you know, I own disability insurance, so that certainly must be the same thing that long-term care is, or at least do the same thing, but that's not correct. There is a difference, quite a distinction. They do two entirely different things. Disability insurance replaces a percentage of our income when we can't work, and usually it only replaces about 60% of our income, and typically it ends when we retire, or if we have it through work, when we leave the firm that we're with. Long-term care pays for all the additional care, the thousands of dollars per month of extra care that we're now incurring because we need care. So if somebody has disability insurance, they might be getting a disability benefit and living off 60% of their income instead of 100%, but now they've got extra thousands of dollars perhaps of long-term care expenses that they didn't have before. So you can see how they're really in a shortfall situation. So both types of insurance are extremely important. They both do two entirely different things. Sometimes people think, well, I'm young, I'm in pretty good health, I think I can wait until I'm older. I think I'll end up, you know, saving some money and I'll deal with this down the road. That backfires on an awful lot of people because, number one, they don't end up saving any money. The reason is the premiums are based on our age when we first apply for the insurance. So the older we are, the higher the premium will be. So if someone wants to wait 4 or 5 years to deal with this, they're going to be paying a higher rate because they're older. They're also going to need to buy more coverage at that time because the cost of care has increased because of inflation. So now they're buying more coverage at a higher age rate. Third, they have to pay the future rates that the companies are charging, and rates have always been trending upwards over the last 15 years or so. So now they're paying the higher rates in the future. And the fourth thing is the most important. They very well may not qualify based on their health at that time. I have people, just this week, I had somebody call me that was getting ready to submit his long-term care application, and he's been dragging his feet, and he called me and said, sorry I didn't get back to you. I've been in the hospital the last 2 days with AFib. And I had to tell him, well, unfortunately, now you're probably not going to be, we can't certainly do it now, and you're probably not going to be able to get it for some period of time, you know, provided something else doesn't happen in that period of time. So, you know, a lot of people who wait run into a problem with not being able to qualify for it based on their health. And also, we see in some cases women pay higher rates than men do because they live longer. And so we think that trend we may see continuing as well. Some people will say, you know, I'm not going to go to a nursing home. I've been there visiting. I'm never going there, so I don't need to worry about this issue. But what again, the person who says that doesn't realize is that most long-term care does not take place in nursing homes. Most of it takes place at home and in the community by either family members, friends, some kind of uncompensated caregiver, because the person maybe hasn't planned for this and doesn't have insurance to where they can get the right kind of care brought into their own home. And in fact, for every one person that's being cared for in a nursing home, there's about 6 more being cared for at home and in the community. So the pool of people receiving long-term care is actually much larger than most people realize. And the bottom line really is that all of us, our lifestyle is going to change at some point due to our health. We just don't know when that is. Some people it happens, unfortunately, in their 30s or 40s. Some it may not happen until their 50s, 60s, or 70s, but we're all going to be affected by it. And the key is to plan ahead for this event for when it happens so that we're not caught off guard and we're not in a crisis, management situation. And unfortunately, that I see all too often. I get phone calls from people that don't have this type of insurance, and now they have a parent that needs care or a spouse, and they call me and literally, oftentimes they're in tears on the phone. What are we going to do? This stuff costs $6,000, $7,000 a month to pay for care. We don't know, how we're going to pay for it, how long this person's going to need to be cared for, and then the family members are all altering their schedules, trying to cover time here helping, and it just is a family. It's a family issue that affects the entire family, and it is, I have to tell you, a nightmare for those that don't plan for it. For people that do plan for it, it's still not easy because of the emotional consequences and everything else that goes on, but at least they don't have the stress of not knowing how we're going to pay for this, and they have some help as they're being guided through the process of getting the care that they need. They're not left all alone trying to figure it out. There are different ways that you can address the issue of long-term care, different types of long-term care insurance products or solutions, and that's what I want to cover with you now. The first type is traditional long-term care, and then the second type is called hybrid or linked benefit long-term care insurance plans, and we'll talk about what the differences are between those two. Traditional long-term care insurance is similar to auto insurance or homeowners insurance or health insurance. It's where you pay a premium each year. If you need to collect under the policy, it pays you a benefit. If you don't, you just start again the next year, basically. It doesn't build any value, meaning if you never needed to use the policy and you died, you don't get any money back from the policy, just like you don't under auto or homeowners or health insurance. And if you ever canceled your policy, you've had your plan for 10 or 15 or 20 years and you want to cancel it, you don't get any money back like you don't under auto, homeowners, or health insurance for the years that you've paid it. So it's basically pure protection, and it provides excellent protection. And generally, long-term care insurance has lower premiums because of some of those characteristics of it that I had mentioned. A newer type of long-term care plan that has become very popular for people that have some assets. This is more for people that have accumulated some assets. Is a hybrid or a linked long-term care insurance policy. And some of the differences with this type of insurance is that this type of policy has guaranteed premiums. The premium cannot go up under any circumstances. One of the things that I failed to mention under the traditional long-term care is that the premiums can be increased on a class basis. They can never single anyone out for an increase, but if they need to raise the premiums for everybody in the class, they can appeal to the state insurance department to request an increase, and then it's up to the state to say whether they can have an increase or not, and if so, how much they can have. And that's the same like auto and homeowners and health insurance. Although I will tell you, under traditional long-term care insurance, the actuaries have priced the policies with the intent of them staying level. It's not something where, like health insurance, every year, every 2 years, the premiums go up. They try not to raise the premiums on traditional long-term care insurance, but they have had some increases based on the claims experience that people have incurred. With hybrid, again, the premiums are guaranteed. They cannot change. A hybrid policy, one of the unique features of it is that it always guarantees to pay a benefit, meaning it is going to pay a benefit if a person needs long-term care, and if they never need long-term care, it's going to pay a death benefit. So either way, someone is always guaranteed that they're going to collect a benefit or their loved ones are going to collect a benefit under a hybrid long-term care policy. Generally, a lot of the hybrid plans have a return of premium feature that says if the policy is ever canceled, you can get back, in some cases, 80%, in some cases 100% of the premium that you've paid into the policy, minus any claims, if you've had any claims. So that's a feature that a lot of people find attractive in this type of policy. Another thing is that they basically offer a guaranteed return from the policy, because again, you're going to get a benefit, whether it be for long-term care or as a death benefit, or if the person canceled and terminated the policy. So you're guaranteed to get a return from the premiums that you've paid under a hybrid or a linked long-term care policy. Both approaches are excellent approaches for addressing long-term care. One is not necessarily better than the other. They're just different. There's some pros and there's some cons to each different type, and it really depends on the person's specific situation. Sometimes it depends on their health condition. Sometimes it's easier to get somebody insured with one type of coverage versus the other type. So there's a lot of different things that we take into consideration when we're working with a member, but the point is we will research this for the member and help them get educated about the pros and cons of both types and what makes sense for their particular situation. And the way we do that is through a form. You can actually go on the website. I'm going to show you a slide in a second that has a web address, and you can cut and paste that into your browser and complete a form that you'd like to get more specific information for your particular situation, and we'll be happy to have you work with a long-term care specialist one-on-one that can help you understand what your options are and what's available to you. So for the members, we have discounted rates with certain programs. We have comprehensive coverage. We have a number of carriers to choose from. We basically have all the long-term care leaders in the marketplace, so that the members don't have to spend their time talking to 2 and 3 and 4 different people and going through this over and over again, because we have access to all of the programs for the members. And the plans are fully portable. If a member leaves, they keep their policy. It doesn't change. These are tax-qualified plans, which means the benefits when you receive them are tax-free. You don't have to report them as income on your income tax return. And spouses and family members are eligible to participate in the program as well, of course, depending upon their health. So this is the link below the phone number here, that if you want to cut and paste this link into your browser, you can click on that, and then there'll be a short, brief little form that you can complete that will allow you to be contacted so that we can get more specific information about your individual situation to be able to provide you with quotes and options and solutions so that you can educate yourself about how this works and what might be the most appropriate type of approach for your situation. That's the basic information that we wanted to cover with you. I'm going to see if there's any questions that I can answer. Let's see. Is there now a preference for at-home or in the community Medicaid? I think what they're saying is, does Medicaid have a preference for at home or in the community versus facility? Unfortunately, what we see, most of the Medicaid care that's provided still is in skilled nursing facilities. They have some Medicaid waiver programs that can allow for, in some cases, home care or assisted living facilities to be covered, but in a lot of states, there's no funding for those programs, very little funding, so there's long waiting lists and people are not able actually to access those benefits at this time. In a lot of states, I know Florida is definitely a state where we see that happen a lot. Again, I want to remind you that the way to ask questions is to go to the toolbar on the right-hand side, and you can click on there and be able to ask a question I think it's in the chat box where you can click on there and be able to ask a question. So we'll wait just a few minutes and see if we have any other questions. And Naomi, if you're able to chime in, if I didn't give them the correct instructions for how to ask their questions, where to go to on that box on the right-hand side, please feel free to clarify that. I do see another question here. What do you think the best age is to purchase coverage? You know, that's a very interesting question. I get that asked all the time. There is no right age. See if this answer makes sense to you. There is no right age. And the reason why I say that is some articles will say 55. Some will say 60. I bought mine at 39, and I'm a long-term care specialist. So which one of those ages is right? They can't all be right. Well, the answer is none of them are right. There is no right magic age. And the reason is because long-term care, qualifying for it, is based on somebody's health. I have a friend that in his 30s got MS. Well, he could never buy long-term care insurance once he got diagnosed with MS. I worked with a lady a while back, husband and wife. The husband we were able to insure. The wife got turned down. She was 57, and I'll never forget what she said. She said, I'm telling everybody I know they better get this insurance before they turn 50, because she said, I didn't have either of the conditions that I got turned down for until I turned 50. Well, in her mind, you couldn't convince her that 50 isn't the right age, that you need to buy it, before you turn 50. So the reality is, I tell people the current age they are is probably the right age, unless they're 20. If they're 20 or 25, they probably don't need to be buying long-term care insurance at this point. But other than that, once people hit their 40s, that's a great age to start looking at it. And I have people that wait until they're in their almost 70s. I'm talking to a couple this afternoon, 67 and 68. Well, their premiums are going to be a whole lot more, and they're going to say what everybody always says, boy, I wish we would have been smarter and done this when we were younger. And then I have to remind them, well, you had a lot of things going on. The important thing is you're still in good enough health that it looks like you have this option. A lot of people, when they hit their late 60s, aren't in good enough health. So it all is driven by a person's health. Okay, let's see. If you've been previously denied coverage, is it possible to apply again and be reconsidered? It is. It depends on a couple of things. Just because you've been declined by one company doesn't necessarily mean that you'll be declined for every company or every type of long-term care insurance. Now, having said that, there are some medical conditions where that would be a true statement, that if you've been declined by one, you're probably going to be declined by everybody. For example, if you have MS, you're not going to probably get long-term care insurance with any company. If you have Alzheimer's, if you have memory problems and you've told your doctor, I'm getting forgetful, and now there's records, medical records that you have some memory concerns, you're probably not getting long-term care insurance from anybody. But putting some of those major ones like that aside, if your situation has improved and things are different than they were when you once got declined, that would be a reason that you might be able to be considered from another company. Secondly, even if your situation has not improved, there may be another company that would look at that condition differently. For example, a diabetic that takes insulin, certain levels of insulin, some companies might say, we won't insure at all. In fact, I'm working on somebody right now that some companies said we won't take them if they're using insulin, or if they were a type 1 diabetic, another company, feels like they would consider them under a different type of approach. So that's the best answer that I can give you to that question, is just because you were denied does not mean that you can't get it with another company, but there could be certain conditions where you might end up getting the same result. Any advice on lump sum versus incremental payment on these policies? I do a lot of both types of these plans for people. People that have more wealth and more asset really like the lump sum approach. I will tell you though, just shooting straight with you, if you're working with a financial advisor or a financial planner, I've seen them try to nix those deals sometimes because they don't want to lose that money that they're investing for you. And so sometimes when I'm working with a client who has an advisor, the advisor will tell them, well, I think it's a great idea, but you ought to pay for it over time. And I know usually the reason for that is they don't want to see that lump sum of money leave and then they're not earning a commission on it anymore. You can do it both ways. You put more money into it if you pay for it over time with incremental payments than if you pay for it with a lump sum. So again, people that have more assets, I definitely see them go the lump sum approach, unless they're talked out of it by someone that might have a different vested interest. But there are cases where people say, I love the approach of a hybrid plan, but I don't have the lump sum of money to move into it. And the beauty is you can pay for that through increments over time. And sometimes a strategy that works for that is if somebody is over 59 and a half and they have money in their 401k or IRA, they can take withdrawals every year from that, pay their taxes on it, and then fund over a 10 or a 15-year period or even a 20-year period a hybrid plan as opposed to doing it with a lump sum. If somebody's only source of money was from a qualified plan, they had $500,000 or $600,000 or $700,000 in a qualified plan, you know, and that was where all their money was, I wouldn't suggest that they take 100 or 150 or whatever the amount was, 1,000 they wanted to take and put into a hybrid plan. I wouldn't suggest they take it out as a lump sum, you know, because they're going to get crushed on taxes all in 1 year on that. But if they have other money that's outside of a qualified plan that they can reposition, then it makes a lot of sense to use a lump sum approach versus paying for it over time. But when we work with clients, we can show you both of those approaches, and you can make that evaluation, you know, for yourself as to what you think is in your best interest. And again, this is what we do with the members that ask for assistance. We go through all of this with you so that you can really get informed and get the proper education and make the right decisions about this. Let's see. What are the main pre-existing conditions, restrictions for denial of coverage? Okay, that's kind of two questions. The main pre-existing, no, actually it's not. The main pre-existing conditions and restrictions would be things like diabetes with insulin, especially if you have complications. Now, we can get people insured sometimes, but it depends on if they don't have complications. If you've got neuropathy, which is numbness or tingling in the extremities, or vision loss, any complications, that's a problem. If the A1C, which is the reading for diabetes, is very high, which means it's not well controlled, that's a problem. Any kind of Alzheimer's, memory issues would be a reason for denial of coverage. MS, Lou Gehrig's disease, you know, things like that. You can have comorbidities where maybe somebody has heart problems and diabetes, even if it's type 2 diabetes, which normally isn't a problem if it's well controlled on medication. But if you combine that with heart conditions, maybe heart attacks, stents, bypass surgeries, that can be an issue. But believe it or not, a lot of people can be insured for long-term care insurance. I don't want to make it sound like it's very difficult to get qualified for, because most people can qualify for it, but they just have to do it before they have some of these, you know, really problematic conditions to the insurance company. But certainly we get the vast majority of people approved for long-term care insurance, so I don't want to make it sound like it's that difficult to get qualified for, but certain conditions, you know, are a problem, no question. Will rheumatoid arthritis disqualify you from being approved? Not necessarily. It can, if it's really severe rheumatoid arthritis, depending on the medication that's being taken for it. But there certainly are people that have more mild forms of rheumatoid arthritis that are doing pretty good, that it is possible to get insurance on. So that's one that I would definitely click on that link, and then we'll ask you to provide some information. I'll get back in touch with you and ask you to provide some information that I can research it for you, but that's definitely worth looking into. So that's one that can go either way, but we have certainly had people insured with rheumatoid arthritis. If you have an HSA account, can you pay for the long-term care premium from the HSA account? An HSA account, you can. A cafeteria plan, you cannot. But an HSA account, you can pay for your long-term care premium out of the HSA account. Okay? Let's see if there's any other questions. It sounds like with this linked hybrid long-term care, since you have nothing. I'm not sure if I understand this question. It sounds like with the hybrid long-term care, it seems that as soon as you have enough income to pay the premiums, you should immediately apply, since you won't save anything by waiting since spring. Oh, well, that's true, but that's true with traditional long-term care as well. The sooner you apply, the better off, because the premiums are going to be lower, and your odds of qualifying for the coverage are going to be a whole lot better. So, so that is true, yes, if I'm understanding that question correctly. Do most long-term care policies have total benefit amount limits? Most do now. Back in the day, most all companies offered what was called unlimited or lifetime benefits, to where it would pay for as long as you needed care. Most traditional long-term care policies now limit the coverage to 5 or 6 years. Now, the reality is, statistics show that that's adequate for the vast majority of long-term care claims. They don't go beyond 5 or 6 years. But obviously the insurance companies have done that because they're concerned about the ones that do go beyond that. Hybrid plans, we still have a way with hybrid plans where we can get lifetime unlimited benefits that last forever. But most traditional long-term care policies do have benefit limits, and like I say, it's limited to 4 or 5 or 6 years rather, once you start needing to use the care. But you may not need to use it for a long time. The clock doesn't start on that until you're actually on a claim and needing to collect benefits from your policy. Okay, let's see if we have another question here. What type of physical exam, blood testing is required? Well, that depends upon your age and the amount of coverage and the type of policy that somebody is purchasing or applying for. On some traditional long-term care plans, under certain ages, you don't need physical exams or blood testing. On a lot of the hybrid plans, on some of them you do, based on the level of coverage that you're applying for, because they're basically a life insurance policy that you're getting a death benefit if you never need to use it for long-term care. So they're underwriting it based on that as well as the long-term care, although actually sometimes the underwriting can be easier on a hybrid plan than a traditional policy, depending on the person's age and their health conditions. Meaning sometimes we can get people insured for certain types of hybrid plans that they may not qualify for under a traditional long-term care plan. At a lot of ages, for traditional long-term care insurance, it's basically just an application that gets completed and a telephone interview where the insurance company or their vendor calls you and asks you some medical questions and verifies information that was put on the application. But then above certain ages and certain types, as I mentioned, there are physical exams and just a regular routine blood test that would be done. And those are done by nurses that come to your home or your place of business. It's not where you have to go to a doctor and see schedule an appointment, see a doctor for that. Okay, let's see if there's anything else here. Okay, here's one. Is a hysterectomy disqualifying with no cancer? No, it would not be. Now, if you'd had the surgery in the last 4 weeks or something, the company might say, hey, we want to see 3 months, just to make sure you're back, you're fully recovered and recuperated. But no, that would not be a problem. Again, unless there's any extenuating circumstances that I'm not aware of, but from the question, no. Okay, let's see if we have any other questions. There's a question here, are there any plans which can be spent on the same things as a special needs trust would be set up to pay, assuming they aim to spend down and qualify for Medicaid? Well, I don't know that it would track the exact same things a special needs trust would pay. What long-term care is going to pay for a long-term care policy is for the care that somebody needs, whether it be a home health aide at home, or if you need a skilled care, whether it was a physical therapist, a speech therapist, somebody like that, or your room and board if you were in a facility, in an assisted living facility or a nursing home. So without knowing, all the areas that would be covered under special needs trust, I don't know if it would track that, precisely. It probably wouldn't in some areas, but a long-term care policy, they're all going to pay similarly. They're all going to pay based on the types of care that I've described in answering this question. Okay. Good question here. Does a mother and grandmother's death from Alzheimer's affect ability to get insurance? The answer to that is no, not now. However, in the future, I wouldn't be surprised if it does have a bearing, unless legally for some reason the insurance companies aren't able to do that. But they ask if there's been a history, but I've never seen a situation where that disqualified the current person from applying for coverage, unless there were already some memory issues showing up and they had been to the doctor and there's information in medical records that they're concerned about their memory, things like that. But no, the fact that a family member has had Alzheimer's presently does not affect one's ability to get insurance. But I will tell you, that's a reason to me that if someone's in that situation, the person that's asked this question is concerned about it, I would not wait on that, because again, as more and more statistics and information come in, I wouldn't be surprised if down the road there's a different answer to that question, unless for some reason legally the insurance companies are prohibited from going in that direction. And once you have a long-term care policy, the insurance company can never change the provisions in your policy. They can't cancel your policy. As long as you pay your premium on time, they can never cancel your policy. You can cancel them, but they can't cancel you unless you didn't pay your premium on time, and then they can cancel it, but they give you a grace period even in that event for paying your premium. There's a question here, is there a percentage of premiums that is refunded upon cancellation or death benefit? Yeah, and as far as cancellation, it can vary from company. Some companies it's 100%, some it's 80%. On a death benefit, it's going to depend, usually in most cases, depending on the way we structure these, that when somebody passes away, if they didn't need long-term care, in most cases, they're actually going to get back, their estate's going to get back more money than they paid in premiums under the death benefit if they haven't used it for long-term care insurance. And again, that's going to vary based on someone's age and their health. So some of these answers I'm having to give you are, I have to be a little general because it varies depending on the specific situation. But for somebody that's in reasonably good health that's doing this, in their 60s or so, a lot of times we see that the amount of money from the death benefit that would come back to the estate is more than the premiums that they would have paid over a long period of time or as a lump sum. And that's going to be more true if it's paid as a lump sum than if it's paid over time, but it still can work out that way. Can you review existing long-term care policies we took out about 15 years ago? We can, but I will tell you in most cases, it would not make sense to replace a policy that was purchased that long ago because the premiums have gone up ever since for long-term care insurance. And, people that bought it that long ago that were smart enough to buy it back then, if it was with a decent company, those premiums you can't even come close to touching today. And a lot of times there are benefits in those plans 15 years ago that you can't get today. For example, I was talking to a client the other day that had a policy from I think back in 08 or something, and we had lifetime benefits on their plan. And I was telling them, you can't buy that in a traditional long-term care policy now, with the company that you have or most any company for all the money in the world. It's not offered. So, you can review it, but when I see a policy, even if I see a policy that's 5 or 8 years old, unless it was just a terrible policy with a company, that's not a very good company and they didn't buy nearly enough coverage and they don't have inflation protection or things like that, almost always it behooves someone to keep that policy and if anything add to it and supplement it. That way they're only paying the current premiums at their current age on the additional new coverage that they would be adding to their policy. So I hope that makes sense. Okay, I have a traditional long-term care policy in place. They just raised the premiums after paying in for about 4 years by 20% and have further increases in scheduled over the next year. Can a traditional policy be converted or shifted to another carrier for a hybrid policy? Well, not really. I mean, you can, but you have to cancel it, and you're just starting over again. And I've had people that have done that. They just realize once they get educated about a hybrid plan that for their situation, they feel like that would make the most sense, and then they don't have to worry about the premium ever going up. But there's not a way to exchange it or convert it or some way to where you're not just canceling it and starting it all over again. But again, that still might be the right thing to do if you're not happy with the plan that you have or the design of it. Okay, let's see. Well, these are good questions that people are asking. It looks like we may be at the end of the questions. Oh, well, yes, okay. I don't see a new one yet. We still have a lot of people who stayed on the call. Okay, there's a question about what's a typical premium for a 65-year-old in good health, traditional hybrid. Unfortunately, I do get that question asked, but that's impossible to answer because it's kind of like someone asking me, how much does a car cost? Well, it depends what year is the car, what make is the car, what model is the car, what options are on the car. There's so many different variables that go into play that there's really no way to answer that question generically. But, what I can tell you is generally we can design the premium to fit about any budget that somebody's trying to stay within. You may have to make some compromises in the amount of coverage per month that you're provided or the length of the the benefits that the coverage lasts for, things like that. But usually we can, modify and work with a plan to fit about any budget that somebody's trying to stay within. There's a question here that says, would you advise against genetic testing as results and awareness of results could be made available as part of one's medical records? I don't know that I'm qualified to answer that, because I don't know if, even if that's in your medical records, I don't know if legally if insurance companies are allowed to use that information or not. So I don't know about that. Now, what I would tell you is that I wouldn't do that until I bought my long-term care insurance, if you had, unless you'd already done it. So, and the reason why I say that is sometimes I have people that I'm working with, and they'll say, I'm going to hold off on this because I'm scheduled to go to my doctor next month for my annual exam anyway, so I'm just going to wait until after I go there and make sure everything's fine. And I tell them I sure wouldn't do that, because once you know something that you don't know right now, once you know about it after you go to the doctor, you have to disclose it on the application, and that could affect your ability to get insurance. Right now, you can honestly answer no to things that you're not aware of that you may be aware of after you go to the doctor. So I always advise people, to get their long-term care insurance before they're going to have different medical tests done, for that very reason. Question, can coverage be stacked with multiple policies? Excuse me. The answer to that is yes, it can. There may be an overall limit that companies will have where they'll say, well, we're not going to let you go above $10,000 a month or $15,000 a month or what have you. Some companies may have limits, and it will vary from company to company. But sure, you can stack policies. You could have an older policy that you've had, like the question that came in about a policy from 15 years ago, and they may not have nearly enough coverage now based on what care costs, and they may want to add another policy to it. Absolutely, we do that. That can be done all the time. That's not a problem, as long as you're within the overall limit. There's a question, have any old long-term care insurers gone out of business? Well, there have been companies that have gotten out of the long-term care business. The insurance companies are still going concerns and in business, but they may have decided that they didn't want to market and sell new long-term care policies to any new policyholders, but their existing policyholders are still fine, and that company's still in existence. So there's a lot of confusion sometimes when people say, I heard this company got out of the business. Well, they may have gotten out of the long-term care business, but it doesn't mean they got out of the insurance business and they're no longer in business. And that, that can happen. A company may say, well, we've decided that we want to focus on our life insurance products or our annuity products or something else, a different line of business. This, experiment with long-term care that we got into, we don't feel like we really, are comfortable with it on a long-term basis, so we're going to not sell any new policies. So that certainly can happen. There have been, from years and years and years ago, there may have been one or two companies that, have been in receivership that have been taken over by state insurance departments, but those, quite frankly, were companies that didn't have high financial ratings, and that, agents that kind of knew the business had concerns about them to begin with and would not have written them on clients, but things like that have occurred. Okay, well, we've gotten to the end of our questions, so what I want to encourage everybody to do is to not click on that link, I'm sorry, copy that link, www.memberbenefits.com/LTC/, paste it in your browser and click on it, and then there'll be a little brief form you can complete, and that will let us know that you would like to get specific information on your own situation, and we'll be happy to contact you and help you get educated about this. Appreciate everybody's interest today. Some great questions. What I will tell you is I don't think there's a more important subject that you could seriously think through when it comes to planning for your future and having a financially secure retirement, because 7 out of 10 of us are projected to face this issue. And again, for those that have a plan in place, it's a world of difference than those that don't. And once something happens, our health changes or we need care, we have very few options, and none that are very good at that point. So encourage you to look into it while you're healthy, or in the health that you are presently, because you'll have the greatest chance of qualifying for the coverage that you ever will. thank everybody. I thank you all for your time and your attention, and hope you have a great rest of the week. Bye-bye.